Hi, today I'll talk about financial planning through mutual funds. My name is Rajat Sharma and I am a SEBI registered financial advisor with over 16 years of experience in helping clients grow their wealth through mutual funds, stocks, bonds, NCDs, basically any kinds of financial assets. What I'm going to talk about today are not random picks. My selection criteria is not based on past performance of mutual funds, but it's based on future outlook, current fund allocation, and most importantly, fund expense within the category in which they operate, and also based on where I think they're placed right now. And we will come to that later. So as I go along, I will talk about one important concept before I talk about each of the funds in my portfolio. Now keep in mind, these funds are good for you whether you're trying to accumulate wealth for the long term, and long term for me is at least 5+ years, if not 10 years. So whether you're trying to accumulate wealth over long term, or you're doing goal-based planning for your kids' education or marriage, or you're doing SIP in a fund to save up some money to do an SWP, which is withdrawals in your years of retirement, these 5 funds I think will work perfectly well for any of you. So here you go. My first fund idea is Nippon Large Cap Fund. This is a category topper and it has the lowest expense ratio in its category. The direct plan of this is about 0.67% of expense. And why I like this fund is because it has a consistent track record of outperforming its benchmark index, and its benchmark index is BSE 100 TRI. And BSE 100 TRI, to explain, is the top 100 companies by market cap listed on the BSE stock exchange. TRI basically stands for total return index. So this is benchmarked against the index where all the interest, dividend, capital gains, or any splits or bonuses, basically anything that those stocks make is reinvested in the fund itself, and that's what this fund is benchmarked against. So over the past 10 years, this fund has outperformed its index by almost 5.5%. So even if you compare it with any of the ETFs or any of the index funds in the large cap space, by like Nifty 50 or BSE 30, this fund has outperformed that index by a good margin despite having slightly higher expense. So concept number one to keep in mind is, fund expense is not the only thing you should look at. Actively managed funds, in my experience, will usually outperform their indices if you select from amongst the top 10 funds. So there's a myth that most fund managers do not outperform the index that they're benchmarked against. While true for most of the funds, you will notice that the top 10 funds always remain pretty much the same, and they almost always outperform the index against which they're benchmarked. And how expense is calculated is something you should keep in mind. Look at this chart. This is how SEBI classifies expense ratio for each fund. Basically, the total expense ratio which a fund can charge is based on the assets under management for each of the fund. So if a fund has total assets under management of 500 crore or less, the maximum expense ratio which the fund can charge can not exceed 2.25% for an equity fund. And this includes all your management fee, distribution, marketing, advertising expense, everything. Keep in mind that in India, there is no maximum limit for how much within this 2.5% can a fund charge in terms of management fee. Even if they can well charge 2% in management fee and keep 0.25% for distribution or marketing, or the other way around. So this is a very important concept you should keep in mind. So the second fund that I like the most is Kotak India Equity Contra Fund. Now this is a fund which invests in undervalued stocks or stocks which are not performing in line with the market purely because either they're out of flavor or the companies are struggling because of some kind of market or external circumstances which are not in their favor. Typically you will see, and that's what you've seen with this fund, that this fund will always outperform when the markets are coming out from a bottom, when they're rebounding. And even right now, if you look at the past 1 year performance of this fund, it would have underperformed the top 500 stocks against which it's benchmarked. But when you look at its performance over 3-year or 5-year basis, it would outperform its index. Right now, if you look at this fund, it has outperformed its benchmark index by almost 6-7% when you look at it from a 5 to 7 year perspective. So from some experience, I can tell you that Looking for funds in undervalued space is an absolute must. So whatever is your allocation, have at least one or two funds which invest in undervalued or contrarian investing style. Typically, these would be titled as value funds. There'd be Axis Value Fund or Bandhan Value Fund. This one is called Equity Contra Fund by Kotak. There's a similar fund by SBI, but personally, I like this fund the most because of its allocation. For my third fund, I'd like to add Invesco Midcap Fund. So Invesco Midcap Fund is a fund which invests purely in mid-cap companies. And now I'll come to the point I was making earlier. You should not always look at the expense ratio of a fund. You'll see that smaller funds which have a higher expense ratio will have more opportunity to buy smaller companies because, a fund with a really, really large assets under management will not be able to buy into smaller companies and mid-cap companies which have a lesser market capitalization. Invesco Midcap Fund, if you look at its fact sheet, invests in companies which are, operating in the mid-cap space as defined by SEBI, for which I'll show you a chart just now. So that's how SEBI defines large cap, small cap, mid-cap universe. So this fund invests in mid-cap companies and it has delivered consistent long-term return, maintaining a balanced mid-cap portfolio. It has a very prudent risk management style and is a category topper with a 5-star rating. Although I will say that I don't necessarily look at the ratings for mutual funds because, again, by experience, I can tell you, I have noticed that funds which are in the second quartile of their category, so like if you were to draw a top 10 list in the mid-cap category, fund number 4 to fund number 10, those are the funds which you will see climb up to be the top 3, top 4 funds over the next 4-5 experience. This is purely from experience. There's the only science that supports this is what I've seen over the last few years. So look at the allocation in the Invesco Midcap Fund. What I like most about this fund is that its investments are very nicely split across financial services with 23 to 27% holding in financial services, healthcare holding about 14 to 18%, consumer 15 to 26%, and real estate about 7 to 8%. And all 4 of these sectors, to my mind, are somewhat undervalued right now. It's got a very impressive track record with a 31% CAGR growth for the past 5 years. It's got a reasonable expense ratio for an actively managed fund, which is about 1.8%, on par with its peers in the mid-cap category. So going forward, I think I wouldn't be surprised if this fund outperforms its category and it maintains a very good split across mid-cap stocks. Now, keep in mind that SEBI defines mid-cap stocks as stock number 101 to stock number 250 by market capitalization, which means the 101st to 250th largest company listed on the exchanges. And they can invest a little bit beyond the mid-cap category. That's what they're allowed to do. So within that range, I think this fund is doing a fantastic job. So this is one fund that you should definitely add to your portfolio. And fund number 4. So the fourth fund I'd like to add is Bandhan Small Cap Fund. Personally, I prefer mid-cap funds over small cap funds for a longer term because, most of the years, mid-cap funds tend to outperform small cap funds unless there is an hyper bull market where small cap funds just run away, like in 2023-22, where small cap stocks in general were like through the roof. But that usually does not happen. In fact, that raises a very interesting point which somebody asked me. If you're investing for a long term, why not just invest in mid and small cap funds? Why should you allocate your money between small, mid and large cap funds? The reason for that is that, markets are volatile and so are these funds. Small and mid cap funds tend to be far more volatile than large cap funds. In a typical market scenario, when markets were to fall, you'll see mid-cap and small caps can fall up to 40, 50%, even 60% for small cap funds. And that kind of volatility is not easy to digest emotionally for many investors. Also keep in mind that no matter how much you say that you're going to sell your funds only 10 years from now, the year in which you sell, you never know which cycle is going on in that year, whether large cap funds are outperforming mid-cap funds or small cap funds. So if you want to make a good 14, 15% per annum kind of return, it's better to allocate your funds equally. Yes, if you're like investing for an absolute certainty that you're not going to sell for 10-15 years and you want to do SIPs in those funds, there is merit in investing in mid-cap on small cap funds. And the fifth fund that I like the most is SBI Focused Equity Fund. What I like most about this fund is that it has a very PMS kind of style of management. It holds about 30 stocks, is a little less aggressive than small and mid cap funds. It invests across large, mid and small cap categories, but it's far more aggressive than a large cap fund, a little less aggressive than small and mid cap funds. It's delivered very good returns. I really like the fund manager here. So this is one fund that you should add to your portfolio. So if you have these 5 mutual funds, whether you're doing SIP or investing in them lump sum from time to time, you will make a very, very good portfolio. And believe me, you don't need to diversify with 10, 12 mutual funds. Yes, there is a core portfolio in which you should have a mix of these large, small, mid and value funds. And then you can have a satellite portfolio. So right now, I really like thematic funds in the category of consumption, and within consumption, I like FMCG the most. So there's one fund which I really like, which is ICICI FMCG fund, and then there could be Invesco Financial Services and Banking Fund. So those are 2 funds where you could allocate about 20% of your capital. Those are funds which you could keep changing or flipping from time to time based on what sector is doing well and what sector has not performed over the last few years. This is something you should have 2 to 3 or maybe 4 years of time horizon, which is I would consider short to medium term time horizon. But for most of the part, a long-term portfolio should have the first 5 funds. Those are my top picks.